Let's invite our guest editor for the day, a day we've been really waiting for. Abhay Laijawala, Managing Director and Head of Research at Deutsche Equities, has joined in. Good morning, Abhay. It's a big day for us. Thank you very much for joining us in and for promising to stay through the day and quiz an array of guests whom we have with us. Well, first up, how does it feel? Does it look like, as an expert previously put it, that the stock markets are looking like the Mumbai real estate market? You just don't want to get out because it will be expensive if you have to re-enter.
No, absolutely. In fact, I'm just reminded the market uncannily, Lata, looks like what we saw between 2004 and 2008. At that point in time as well, the markets started exactly in a similar fashion. And everyone thought that the market's looking expensive, and there was no looking back for almost 4 years. So, having seen that, we really should not be making a mistake of ignoring this market, because when you do see a cyclical upswing, earnings growth has to follow, which is what we believe is going to happen.
Okay, Abhay, hi, good morning. Good to see you in. We've been waiting to hear your thoughts ever since you gave us that 28,000 Sensex target a while back, and I think we were just within kissing distance of that mark. But is there any expiry date to this Modi euphoria?
No, I think it's really work in progress, really. The bull market has just begun in our view. And what we are now going to see is markets start to look at, what really happens moving forward. And therefore, I think it's an ongoing process. We think that the bull market has just begun.
Okay. Well, Abhay, I remember that you were perhaps the first person to write your note and even join us on phone. I think that was the election day when you announced that big target, and the markets have sprinted there in a hurry. Do you think there could be one correction before the market climbs? Because even in that 2003-2008 period, we did see one big 10% or even over 10% fall before the market started clambering up again in 2004. So is that kind of a correction possible in 2014, you think?
Corrections have to happen. In fact, corrections will make the bull market far more sensible and far more structural. But, at this point in time, one is really seeing a confluence of factors that actually could lead to a spurt in the market rather than a correction. So we are seeing, 2 to 3 indicators come in at the same time. One is the cyclical recovery that has begun, which we shall talk about during our macro session. And it'll be interesting to have views from our guests on what they have to say on that. The other factor, and this I think is very, very important for us here in India to gauge, apart from India, most other emerging markets have seen consensus GDP downgrades. So in the last 2 to 3 months, in the last 4 months or so, GDP growth estimates by the street for Chile, for Mexico, for Turkey, for Brazil have all been downgraded. And India, conversely, is where GDP consensus growth is being raised. So I think we have to realize that we are looking far better than the rest of the world. In addition, China, over the last 2 months, there was a huge amount of interest in China. China was cheap. Expectation was that Chinese manufacturing is beginning to come back. And I think now, once again, China is, faltering. For example, if you look at diesel demand growth in China, adjusted for the inventories, etc., it's growing at just about 2%, 2.5% or so. And that pretty much gives a signal that the Chinese manufacturing is yet to rebound. So what we are therefore seeing is a reallocation of flows from other emerging markets to countries like India. And finally, the factor that I'm most excited about is that we are seeing the return of domestic institutional investors. As we've written this morning, August was the first month where you had DII flows being positive, and this was the highest in almost a year or two.
Okay, and how much of this is courtesy the new government coming into power? I ask you that because I know you've been meeting a lot of the finance minister, the power ministry, etc. How different is it from the previous government?
No, so I think what we are seeing right now is a confluence of three key confidences, and this, I believe, is an extremely potent driver for both the economy as well as the markets. So what you're seeing is the return of three confidences: consumer confidence, corporate confidence, and investor confidence. And I think that's what I would put as probably the biggest drivers for the market.
Let me come to, how would you play the cyclical upturn? Is this cyclical upturn going to be therefore largely smokestack stocks, unfashionable stocks that you will latch on to?
No, I think we should play a combination of both, I guess, the smokestack as well as, even the mid-caps as well. I think what we have to now really start looking is how sustainable this recovery is going to be. And that's where the cues will come in. So let's see, we've already seen core industrial sector production numbers being very robust. But I think more than the actual headline numbers, what I am very excited to see is that job growth is beginning to come back into the markets. So a couple of surveys have come out in the last 1 month, which have shown that in July, employment was up 15%. So there was a 15% increase in employment generated.
Which data is this?
This is from the Times.com index.
Okay.
And they're basically stating that sectors like the internet startups have reported as much as a 15 to 20% increase in employment. And the other sectors that were seen hiring people were oil and gas, and we saw a big increase in demand from the hospitality sector. So this I'm particularly excited about, because this means that the services sector should probably be seeing reasonably robust growth.
Okay, and that's interesting actually. So before we drill down to individual stocks, I just wanted to get your Sensex target out of the way, because you were the first one to call that 28,000 target. So now where does your, say, year end, or maybe 1 year from now, where do you see the Sensex?
So we have a Sensex target of 28,000 for December. We'll have to see, how earnings progress and how the entire situation evolves. And we'll take a closer look, but we remain very confident that 28,000 is well within reach, and it's likely that the target may be achieved much sooner than December.
Okay. Well, Abhay, is this 5.7 growth sustainable? Or let me put it more in terms of equities. What kind of earnings growth are you expecting this year itself?
Right. So we are expecting close to about 17% earnings growth for this year, as well as next year.
Okay.
But the rate at which the economy is progressing, the data points, and we'll again discuss that during the session today, including the macro session, I will not be surprised if consensus earnings estimates for the market move to the psychological threshold of close to 20% by the December quarter.
Okay.
So we may be exiting this calendar year with consensus Sensex estimates probably moving towards 20%, and that will be a very big driver for the markets, because remember, earnings are the holy grail for the markets.
Absolutely.
And finally, that's what investors will look at to see if this market rally can sustain or not.
But if the government were to come with a fairly big supply of shares, do you think the markets will still be able to give you, both an earnings re-rating as well as a multiple re-rating?
That will depend on, what is the extent of supply. If the supply this year is going to be close to about 10 billion or 15 billion US dollars, we think that there is enough appetite globally for that to be absorbed. Now, if it happens to be 25 billion, which obviously sounds like a very high number, then of course there are going to be question marks. But up to 10 to 15 billion dollars, we think that there is enough liquidity to absorb that.
Okay, I'm still very keenly interested in what your interactions with the government have led to in terms of where the government's focus is to improve the economy's efficiency, and how does one really play that in the market through individual stocks or sectors?
Perfect. So we've had meetings with various different ministries where we took some of our investors to meet with government officials, and the feeling we came back with was that there is intense movement on the ground clearances, on processes, on trying to make businesses simpler. In fact, there is an attempt at streamlining clearances, because this has clearly been a problem over the last couple of years, where projects or approvals were not streamlined. So corporates that once spoke to complained that, fine, we get the approval from the center, but then we have to approach the states, and that's where things slow down considerably. So what we are seeing right now is an attempt to streamline processes not only in Delhi, but there is now an attempt to link the clearance portals, the states and the center. So 14 Indian states over the last few months have now signed up for this coordinated portal. I think this is a very, very positive development. And, you know, one thing will build on another. So our expectation is that as a result of simplifications, as a result of notifications from the Environment Ministry on simplifying a lot of criteria, we could probably see, you know, a quick return of many of these stalled projects.
Anil Swarup was in the channel a week ago, and he said 60 clearances, 25 from the center and 35 from the state, are already on that digital clearance grid. And of course, as you said, 14 states have also joined in using the same software.
That's right.
Abhay, you know, I just want to get one point out of the way. Maybe September 15th itself or September 16th, we will get to know when the Fed will hike rates. Do you think that there can be any international accident to this flow of funds? I mean, we've been pleasantly surprised, even at higher and higher levels, we are getting larger and larger amounts of money, as yesterday's FII inflow proves. So can that pleasant picture be disturbed anytime soon?
No, so obviously that is a concern. In fact, everyone in the world is now waiting for that moment when the Fed actually starts to warn about the eventual normalization of Fed policy. Our expectation was that at the Jackson Hole Symposium earlier, the Fed would probably use the opportunity to guide, but we obviously didn't see that, and now the expectation is that the Fed may do it in the September policy. So, you know, I think you cannot rule out volatility, but as far as India is concerned, we probably are going to be impacted far, far less than what we saw when Bernanke warned about the taper coming to an end last May. So our you know, external vulnerability indicators are today far, far stronger, and our sense is that there will be volatility which investors can actually use to, you know, accumulate, but it will not be as systemically threatening as what we saw in the aftermath of the Bernanke warning.
Okay, so since you are so bullish on the markets, why have you not scaled up your Sensex target yet? You can do it here right now on our show.
And give us a headline.
Well, we'll have to see how things go. We are very positive, and you know, let's see what happens with.
And you have an earnings growth target of 20% for FY 15.
No, that is not for FY 15 and 16. We have a target of 17.
Okay.
But we are saying that consensus estimates could probably move towards 20% as long as this economic momentum continues.
One macro question to you, Abhay. The graph will come up for you. We have picked this up from your report. You had a report saying connecting the impact of reform-oriented leaders to the impact on stock markets. We have Erdogan, when he became the premier of Turkey, taking the stock markets up from a minus 19% to, I mean, equity returns from minus 19 to 83%. The others, of course, are Lula from Brazil, Shinzo Abe of Japan, and of course, Modi, India is still work in progress, I would assume. But over what period is this?
This is 12 months.
Okay.
So, you know, the whole point here is to prove that when you see the appointment of a reform-oriented political leadership, markets do take cognizance from that. I think rather agreed that Turkey, Brazil have all been cases in point. But I think the most important, the most recent one has been Abe. So Japan, 12 months after he was elected, markets returned 58%. And therefore, as I'm saying, that if you see the return of these three confidences, the Indian market has much more to do.
Okay. Well, then let me put the arithmetic like this. 3 months prior to when Modi came in was February 3rd, when the first CNN-IBN poll indicated that it would be a near majority for the NDA. At that time, the BJP was not expected to get a majority. We've already done 33% from that date. It was 6,000 thereabouts on February 3rd. We've done 30-35%. How much more is there for the market? And if you take it from May 16th, when the result got confirmed, or May 15th, the day before, it's a gain of about 15-16%. So, you know what, are we going to look at 83?
That's my guess is as good as yours over here. I think, as I said, it will probably depend on what really happens to the economy, what the government does. And at this point in time, obviously, what they're doing is exactly what needs to be done to move things on the ground. But for the rally to really move to its next level, we will need to see some big bang reform, probably closer to the end of this year. Because
what will you mean by a big bang reform?
I think by big bang reform, I'm referring to the insurance sector deregulation, or the FDI increase in insurance. I'm referring to the rationalization of fuel subsidies. We think that that is going to be the real big bang reform, because India has to rationalize subsidies. So we've seen how successful the diesel under recovery has been, and what kind of an impact that's having on government finances. The government needs to move ahead on cooking gas and kerosene, albeit in a progressive manner. So, and of course, the other big bang reform will probably be incentivizing domestic gas production. India needs to be confident of its energy security. I don't know if you all have seen our report, India 2020, which we put out yesterday, where we say that India is moving to an East Asian model. That model cannot be successful unless and until energy security, material security, raw material security, transportation security are all improved. Otherwise, I mean, we will have the characteristic problems of the entire supply side coming back as soon as growth reaches a certain threshold.
In fact, we discussed that report in great detail yesterday. But before we talk about specific sectors, I just wanted your view on asset allocation for the next 1 year. You know, in the last 1 year, we've seen a lot of physical assets being accumulated. Household savings have gone into gold, etc. What do you do with gold now, and what should the asset allocation strategy be?
I think as far as gold is concerned, clearly the best appears to be behind us. And one of the key reasons why India got into that obsessive love affair with gold, if I can say, was because of two key factors. One was real interest rates were negative, and two, international gold prices were moving up. So that resulted in gold emerging as a relative investment option, and resulting in this massive skew that we've seen in physical savings, which moved to an, you know, unacceptable percentage of 65% of total savings, and financial savings as a consequence came down to just 35%. Our view is that over the next 12 months, over the next 24 months, investors, if they have not switched, must switch from physical assets like gold into financial assets, equities, fixed income. They're both looking attractive at this point in time.
Okay, so that of course is positive, but would you put some money in fixed income at all? If Raghuram Rajan's 6% inflation target were to be reached, is there a lot of money to be made in long bonds?
Well, I am basically, you know, an equity market investor, so I'm partial to equities at this point in time. So I would say that increase the allocation to equities, because this is going to be a 4 to 5 year bull market. The bull market has just begun.
Okay, well, now to come to sectors, because I think Kaushik should be joining anyway. Bombay's traffic has never been kind, and perhaps is a little more unkind today. But what should be the sectoral allocation? If you are looking at, let us assume, just for argument's sake, an 83% rise in the Nifty, of which only about 16 has happened, or even if you take 33 has happened, there's another 50% waiting to happen. Which would be the sectoral leaders? Should it be metals? Should it be banks? What?
So the sectoral leaders are primarily going to be those that are, you know, linked to the cyclical recovery. So this would include the entire, you know, space from banks, to consumer discretionary, and going all the way to sectors like oil and gas and even capital goods. So, you know, this, and of course materials, because you cannot see this East Asian model without materials intensity, and we remain very confident that this government is moving on that path based on everything that we have heard so far from the Prime Minister, even before the election and after the election.
So will you distinctly allocate less for pharma and IT?
You know, we like IT as well. So we don't have coverage of pharma, so I'm afraid we don't have a view. But as far as IT is concerned, we think that just because you know, the domestic economy is doing very well, investors have very good money-making opportunities in the IT sector as well. You know, very importantly, IT spending this year is going to be increasing very robustly. Indian vendors have been taking market share away from the multinationals. In fact, the share of multinationals in IT services has come down from 75% to 60%. And, you know, our IT analyst Anirudh Bhosle believes that top-tier Indian IT vendors are on course to reporting US dollar revenue growth of anywhere between 10 and 22%. Okay. Which is very, very robust. So we cannot ignore IT. We are very positive, in fact, albeit selectively through our key stock picks.